Okay, so what is buy-to-let or property investing? Well, there are many different variations to how we can invest into a property, what we can invest into, and locations. And I'm going to be talking about some of those themes later on in some subsequent videos. Ultimately, buy-to-let as a concept is buying an investment property, buying a house, a flat, a property type with the explicit purpose of making money from it, renting it out to a third party. Now, when choosing an investment property, a lot of people here in the UK don't make decisions based upon data. And what that means is they let sentiment creep into their decision making. For example, here at GetGround, a lot of our consultants here very familiar to the words, "I've found a property round the corner from where I live, and that therefore must make a good property investment." And the reality in the situation is actually very, very different. Just because you're physically located close to a property that appears to be a good price with an agent or seller doesn't necessarily mean that it's a good investment for you. So what we would say is, during the course of these videos, please be aware that we would like you to be, and we would like to work with you on the basis that you're as data-driven as possible, and any sentiment in your decision-making, any personal feelings, any personal preferences are removed. And of course, this is something that we would typically do if we were looking at other asset classes, stocks and shares, as just an example. Okay, so how do we actually make money from buying an investment property? Well, the good thing about buying an investment property, or what we call buy-to-let, is that there are two ways in which you can make income from the acquisition. The first is rental yield, and rental yield is the amount of money that the tenant pays to you on a weekly, monthly, or annual basis. We measure that in percentage terms, and it's the amount that you're getting in rent on an annual basis divided by your property's value that year. The average for the United Kingdom at the moment is around the 4% mark, and that is true as of November 2022. The second way in which we typically make money from investing into property is through capital gain or capital growth. Capital growth is also measured in percentage terms, and it is the percentage change in your property asset's value over a given time period. And here in the United Kingdom, we use 1 year. The average for the United Kingdom generally is about 2.5% to 3.5% every single year. Now, of course, as I'm sure you can appreciate, speaking about the UK as a kind of average is often not very helpful. So it's very important when we're looking at these two data points to understand how different property markets or different geographical locations affect those numbers. For example, London at the moment, again correct as of November 2022, doesn't actually represent a particularly compelling investment location from a purely data-centric perspective. The average property in London is actually only achieving about 1.5% to 2.5% in rental yield on an annual basis. And because property really in central London is out of the reach of most people, the capital gain that most people are getting also isn't very high, roughly 1.5% per annum. Now, if we compare that to somewhere like central Manchester, as just one of a plethora of examples that I could give to you, we see capital growth in Manchester at the moment at about 4% on an annual basis, and that's certainly showing true as of about the last 5 years, with rental yields being in excess of 5.5% to 6%. So from a purely data-centric perspective, it's very important that we understand how different property types and different geographical locations can affect our investment pedigree. Great. And so now that we know that making money through property is through two main ways, rental yield and capital appreciation, How do we know which is a good investment property to make? Well, really the choice is yours, and we need to decide which strategy is right for you. Are we capital gain focused? Meaning, are we buying a property that is going to rise in value very, very strongly over a given time period? Are we rental yield focused? Are we going to look for a rental yield that is considerably higher than we would find in that market as an average? Or are we going to go for a hybrid strategy, which is where we find a great mix of both of those two metrics with an equal focus? Really, the decision is yours, and of course we will work with you throughout the course of your property package adventure with us to find the most suitable strategy for you. Now, when you combine both rental yield and capital growth, we get the total annual return on your investment. And you may see this written within your property package as an ROI. And again, that stands for return on investment. That will be an annual figure. Really, as of November 2022, we would be looking for an annual ROI for you, perhaps over a total of 5 to 10 years as an investment plan, of somewhere between 8 to 10%. And we really think 10% is your golden figure. So it will be up to you to work with your consultant to understand which of those strategies is right for you, but we will always be trying to aim for anywhere between 8 and 10% as an annual return on your investment. So it's very important, even though we've identified perhaps which type of strategy that we'd like to go with, that we also understand the effort and ability level that may come with a specific property type. For example, later on in the series, we'll be talking a little bit about houses of multiple occupancy, or HMOs. HMOs are widely thought of as being a very profitable investment class, but there's also a lot of regulation and a sometimes frightful amount of work that needs to be done in order to run a HMO type investment well. Now, of course, that might not be right for everybody. We might actually be quite passive in our investment aims and objectives. We may not want to be worried about changing light bulbs or doing regular checks on the property, or being involved in the renting or the tenanting of that property on a daily, weekly or monthly basis. So it's very important, whilst we understand that we want to maximize your return on your investment or your ROI, we also want to balance that with the realities of owning and operating an investment property. So we find property as an asset class to be very accessible generally, provided you've got the minimum amount that you need in order to be able to invest into a property, which tends to be around 25% of that property's price. You're good to go. As a general summary of the benefits of property as an asset class, we have dual forms of income, rental yield and capital gain. It's a pretty resilient asset class. Many people use it as a hedge against inflation, which again, in the context of November 2022, is quite a pressing subject for us here in the UK. And we also know that since about 1970, property has risen in value generally by about 3% per annum. So really great form of income, rental yield, capital gain, and we also know that it's very resilient as an asset class as well. Now, it's worth mentioning at this point that what you are about to do, if this is your first investment property, or perhaps a subsequent investment property, is you're actually going to be starting your own business. You're going to be buying an asset with the explicit purpose of renting that property out. So you're going to start your own business. We think that when you start your own business, it would be ideal to look at starting that business within a limited company structure. And that's one of the things that here at GetGround we specialize in. We'll be talking a little bit more about that as we go.